This is the 3 most common tax misses that we saw in 2025. Hi, I'm Steven. I'm CEO of Perspective, an advisory firm in the beautiful Colorado. And we get to look under the hood of some really interesting financial and tax situations. Now, this particular matter is very serious to me. I'm very passionate about it. I have to even walk and talk. I can't just stand in front of a camera to do this one. And, you know, I'll start with the first one of 3 that we have found is the way that state income tax is paid if you're a business owner or receive 1099 non-employee income. So if you are 1099 as a contractor or you're a business owner and you pay your state income tax from your personal bank account, you're probably doing it wrong and you're probably costing yourself quite a bit of tax savings. Now, there's nuance to this. Not every tax election status allows you to create this tax deduction on what you pay to state income tax. And not every state even has this particular issue, but most states do. And it's something you need to be really aware of. The biggest example I'll give you from last year, we found a business that started saving $150,000 a year because they started paying their taxes for the state through their business. Why no one's ever brought it up to them? I don't know. They pay multiple tax firms to do all their work, but that's how it goes. Second that we commonly see is the way after-tax contribution is made and handled for clients. That separates into 2 categories. There's after-tax IRAs, and there's after-tax contributions inside of a 401k. If you make over basically $240,000, you can't fund a Roth IRA in a conventional manner. And you can't take a tax deduction, usually can't take a tax deduction on a traditional IRA. So people will fund an after-tax IRA, but we hope and pray that they're going to convert that to Roth. Will that is often missed. We will see a miscommunication between the CPA and their wealth advisor where they will not get the conversion done. And so now they have this account where they pay tax to get in and they pay tax to get out. It's really unfortunate. Our worst case study we can give for this is we have a client with $360,000 in an after-tax IRA. And for whatever reason, no one along the way had them convert. They've only put $80,000 in. So they have $280,000 of gains that should be tax-free. Should be tax-free. But they never converted it. Now they're stuck. And to undo that is fairly painful and very challenging. There's a rule called the pro rata rule that kicks in. Point is, just convert your darn after-tax contribution to Roth right away. Second is through the 401k. Most people think, well, the max I can put into a 401k is $23,000. That's not always true. There's a lot of 401k plans. This is particular to our executive clients where they're actually allowed to do after-tax contribution because at the plan level, the max amount of money that can go into a 401k is actually $69,000 last year. So the difference between $69,000 and $23,000 allows for this after-tax contribution, and that's where the match and other things kick in. Well, what we often see is either they're doing the Mega Backdoor Roth correctly and converting to the Roth 401k, or what's really bad is they forget to convert, they don't set it up correctly. They don't even know they could convert. Somehow they just started putting money in after tax. Or the worst is they cap out the $69,000 where they now prevent the match from coming in because they've capped out, but they start losing thousands and thousands of dollars of match and they didn't even know it. We find that all the time with executives. So if you're an executive funding an after-tax contribution in your 401k, there's often, unfortunately, some opportunity we find there. Now, The third thing is missed deductions that were on the previous year's tax return. So you were writing something off, and then for whatever reason, the way that documentation came over to your CPA this year, it was missed. And we commonly see this, especially because most of tax work is a churn and burn model. They take what you gave them, they throw it in the software, get it out the door. And no one takes the time to compare the previous year's return and the current year's return and say, missing here. And the real break in this whole chain is that the advisor, the wealth advisor and their CPA have never even talked to one another. So all the tax stuff that's going on at the wealth advisor level gets missed, and there's no synergy. Getting your wealth advisor and your tax advisor on the same page is gonna patch up a lot of those missed deductions. It's gonna prevent things like the failed Roth conversion and so many other things. So the biggest action step you can take from today is, if you're a business owner or a 1099 income earner, to consider how you're paying your state income tax. And if you're paying it out of your personal account, there's opportunity there. If you fund an after-tax contribution of any kind, there's probably opportunity there. And third, getting the missed deductions eliminated by having the previous year and current year tax return reviewed together. Get synergy across your two advisors, and good things will happen. Blessings.